Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through social media, Twitter, see what people are sharing. I'm going to sprinkle in my financial opinions as we go, and it's going to be related mainly to three topics: commodities, wealth building, and financial topics. So let's dive in and let's see what's going on that people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. That is where I share individual companies, individual stocks. I do not trade positions, although you probably could trade some of these positions based off of the entry points that I provide. But returns have been pretty good last year for 2023, or I should say this year, I guess. We're still in 2023. So lots of really good opportunities out there right now. So coming on down. Game of Trade says this has only happened 3 times since 1947. Savings as a percent of gross national income is now contracting. The last two contractions coincide with the 2008 financial crisis and a 2020 pandemic. So there it is. Savings are contracting. You can almost see like this is almost bottoming. And are we going to come back up where savings as a percent of net savings for percent of gross national income, will that go back up? I don't know. But it is interesting to see that it is contracting right now. Gold, the 14-year blue bullish falling wedge is close to a breakout. Last time this ratio had a mega breakout, the secular gold bulls started. This breakout will confirm the start of the second leg. Above 0.50 means new high after breakout. We are a go. So this is gold divided by the S&P 500. We've got a falling wedge that we are about to hopefully break and enter a second leg of a secular bull market. And that's where the ratio, man, if we can go all the way back to 80, the appreciation of this ratio over the S&P 500 going from 0.43 to a top of about 7. So that's over a 14, 15 times outperformance of gold versus the S&P 500. It was very difficult for me to accept how little career advancement in many fields has to do with raw technical abilities, and so much of it to do with winning allies and being selectively loyal. Sure, there's a base level of competency at play, but mostly work feels fake. And I was just looking at this, and I agree. Where I worked, it's all about connections, business connections, and basically who you're loyal to, selectively loyal to. I would agree with that. It does very little with raw technical abilities. If you can take your raw technical abilities and somehow make money from those technical abilities, that's your best bet. Is to basically become a consultant, become someone who can earn the higher rate, like the shop rate that people pay, rather than having the shop rate go to the company. You'll be netting that difference. That difference, probably for most people, is the difference of like $50 an hour versus like $300 or $400 an hour. It is a big difference. And that's really where you can make a lot of money if you can do that. It says workers disapprove of professionals for other reasons as well, stemming from the requirements of professional and managerial jobs. Basically, it depends on the significant part in tact, friendliness, conflict avoidance, and teamwork. I won't read through all this, but basically, you have to fit within their culture. They have to have a positive viewpoint on you as a manager or a technical person. And then you get promoted based off of the buddy-buddy system. That's what I found. URNM, this is how accumulation looks in charting. This is not distribution, higher incoming. And this is the Sprott Uranium Miners ETF. So if we look at this, and we were to kind of look and dive down into this a little bit, says the sign of strength in front of resistance, higher incoming. And we can see that we are at a very strong stochastic and or relative strength, and we are consolidating. We can also see that we have very small selling pressure up against resistance. If this is going to turn, you'd see these large red candlesticks, these big boys there. But we don't have that right now, and I think he's right. I think we're going to break through and we're going to run. And what's important here is once you break these kind of last resistance levels in some of these areas, like URNM, URNJ, you don't have any further upward resistance once you break these all-time highs. So basically, it's just soft resistance overhead or no resistance where you can just fly on up. So you're in a fly zone is what we call it. You enter a fly zone where the stock price can fly. Uranium just broke 91.36 per pound. Prices are now at 16-year highs, yet still well below the record. And that's the uranium pricing. Big move. How much workers think they need in total savings to live comfortably in retirement? So how much do workers think they need in total savings to live comfortably in retirement? 10% think they need less than 150,000. That's pretty low for retirement. But you know, I would say 1 to 2 million is probably a good guess at this time, or 750 to a million. That's probably on my realistic end. Kind of on the low end for 750. 1 to 2 million is probably pretty good. 2 to 3 million is another good guess. But it really depends. And I like this answer here where 25% say don't know. I don't really know either, because if you're in a highly inflationary environment, this is going to move all around, and you're going to have to stay invested, even through retirement, just to maintain enough money. I think you're going to have a high weighting to still some pretty good risk. I don't think 20 million plus. I don't think that's the right answer unless you have a really high cost or high standard of living. That seems like pretty excessive. Retail is back. Total gut feel on when this ends, but I'm thinking second quarter of 2024. And what does that mean? It says, number one, the retail era. I don't think you can find a more iconic chart to represent one of the biggest changes in markets of the past decade. Thanks to a combination of stimulus, boredom, greed, and technology, retail animal spirits were ignited and they're not leaving. So this is the retail investors have piled into the US markets this year. You can see that it's higher than any time in history. So is this good? Is this a sign that we're in a bubble? I don't know. I do not know. Because, I mean, it's not good when retail's all piled into it. That's what I'll say. Gold Investor Research. He says M2 money supply. If you look, we've been contracting in M2 money supply. Been going lower, 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 lower. And then recently here, I'm talking real recent, like October, November, it's been coming back on up where the M2 money supply is increasing again. Maybe that's what's causing some of the movements in the market, is that move higher in the M2 money supply that we're finally seeing. Humanity has a moral obligation to produce as much energy as cheaply and as cleanly as possible. Anything less is asking the future to be worse than the present. And this is a chart that shows there's no such thing as a low energy rich country. As countries become more wealthy, they consume more energy, aka wealth is energy consumption. So if a lot of these countries, like India, you can see how big it is, and China, if they want to continue to get richer, if they want to get to the United States, all of these dots have to move to the upper right where they consume more electricity and with higher income. OBE, Obsidian Energy Foundation, President and CEO Stephen Locus with 1,000 share buy today in the U.S. market. Go Stephen Locus. 2023 was the 12th best year for the S&P 500 since 1980 so far. 12th best year, guys, is what we've got. So that's good, and I'm glad that I had outperformed the S&P. It's good. It says, Eek, 2024 will usher in the biggest crash of our lifetime and see the S&P 500 plunge 86%, warns economist Harry Dent. Harry, since 2014, I think he's predicted almost every single year that the stock market is going to have this massive crash. I know he did it in the like 2012, 14, 16, 15 probably. He's basically predicted 23 crashes out of 23 years. And he's gotten like two right because we had two crashes since then or something. But he calls for crashes every second. So I don't know what he looks at. That's probably demographics because he talks about that a lot. But he always predicts crashes. Always. He'll probably be wrong. Long-term bears get slaughtered. Short sellers gains and losses. And look, they just continue to lose money. So it pays to be optimistic and it hurts being pessimistic in the stock market. Opening a container freight futures up another 16%. So another strong opening for the containerized freight index futures, up 16% and has now doubled since December 1st. Huge double with all of that geopolitical stuff going on. I think it's in the Red Sea. Crazy. Remember when everyone on Twitter was all of a sudden an equally weighted ETF expert? That was awesome. So equally weighted RSP 52 new week high, and same with equally weighted NASDAQ QQQ 52-week high. Are these highs legit? Are we going to keep running, or are we going to turn back around? I don't know. We'll find out. But we're making 52-week highs on equally weighted stuff. And I also think that this may have something to do with the M2 money supply going up as well. Take a look at this chart, which shows that the ongoing rally in stocks following yield curve inversion has reached a historic high, surpassing 24% red line and outdoing the pre-Great Financial Crisis rally of 2006-2007. This indicator that officially something is different this time, yet this doesn't guarantee a different end result. While we're witnessing a record-breaking rally post-inversion, the future remains unpredictable. Considering the yield curve's consistent success in predicting recessions and the following equity bear market since 1950s, history says the risk of a significant and painful drawdown looming ahead is near 100%. So here we are in the red, and you can see at somewhere in this very similar area, we've always had these large declines in the, what was this, S&P 500? Yes, we've always had large declines, roughly in the same area that we're at. So we'll see. We'll see if we buck this trend. Mexico's silver production is now declining double digits annually for the first time in almost a decade. Historical trends indicate the substantial contraction in new supply have presented excellent opportunities to invest in the metal. So here's Mexico's silver production. Look at that decline, guys. We had a massive decline in 2006, a massive decline in 2016, and we are currently declining in Mexico's silver production on a percent annual change. One of the reasons I think that could be the case is I know that the cost curves in Mexico are higher for some producers than it currently is today for the price of silver. And whenever you're below the cost in an all-in sustaining cost for a commodity, generally that's a good time to buy it and hold on to it because the price generally has to rise for the production to kick back up. And we are running deficits in silver, hundreds of millions of ounces deficit. Stealth wealth is a sign of security, meaning you're confident in yourself. When you have to buy expensive things to prove something, it's a sign of insecurity. I agree with that. And I guess I'm stealth. Maybe I'm stealth wealth. I don't know. But I don't buy expensive stuff. I value freedom. MasterCard U.S. holiday retail sales grew by 3.1%. So that's, I guess, good. I don't know. Um, Sales probably grew, but I'm sure there was less stuff that was purchased if it grew 3.1%, because I'm sure inflation is greater than 3.1%. U.S. buys 3 million barrels of oil for the strategic reserve. So whenever they basically refill the strategic reserve, that's almost when prices go up, is when we start to see a lot of buying for the SPR. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. And that's John Bogle. He passed away, but he was the founder of Vanguard. And yeah, in the volatile stuff, if you're swinging for the fence trying to earn very good returns, you're going to be down. You could be down more than 20% on a stock. And some people say, well, you should have a stop loss. Guys, some of these stocks, they go up like 10, 20% in a day. So, I mean, it could just depend if it was a good or bad day, even. Dollar cost averaging explained in one image. So what I try to do is I try not to buy the tops of these things. And I try to buy the bottoms here. The way that I have figured out how to do that is you invest based off the real estate cycle, and you use ratios to determine where we're at within the cycle. So what you would do is you would take all these red dots that are high here, you take all these red dots on the right-hand side here, you remove all of this. You'd have some dots down here, and you'd have some dots down here, and that's it. Because that's when the cycle was prime for, say, the S&P 500 or whatever asset there is. And you'd buy it all down here and all down here. And then when you get that break, then you'd sell it up towards the top. You know, these dots would be sell dots, and these would be green buy dots. That's really what we're doing. Peter says, let the paper oil market do its job. This is not what de-escalation looks like. In the face of very real threats to surety of global oil supply, prices need to be allowed to rise to a level that incentivizes a short cycle production response. Let the market work. It says oil ripping higher on geopolitical incidents, time spreads up. Nice inventory draw this week. It's a bad time to be short and a textbook squeeze with positioning still offsides. With MENA war, escalation, and barrels going back into the SPR in coming months, crude is attractive here. Totally agree with that. Crude is a very good area. He says long oil, short QQQ time again, question mark. And that's with oil going up 2.78%. Big old move. Is it time to be long oil again? And I think it is. That's my approach. Great chart, Alex. This is for your information, politics and markets. Number of recessions starting in the year of the presidential cycle. From 1929 to 2021, year 3 of where we're at is 0. So I don't know. Maybe they're going to pump the market. But looks pretty interesting that there's 0 recessions starting in year 3. Real personal consumption, so factoring inflation, continues to trend higher and is above pre-COVID trends. So this is real personal consumption. 1 year ago, right at now, 85% of economists expected a recession in 23, and a weakening consumer was a big reason. The consumer has been the big surprise winner in 2023, and you can see this thing left to right on a trend line continuing to go up at a 45-degree angle for real personal consumption expenditures. An important lesson here, a 30-year mortgage is a lot safer than a 10 to 15-year mortgage. If you want to pay off in 10 and save interest, just double your payments, but give some breathing room in case of job loss emergency. So that's what my brother and myself, we had a little talk about this, and my dad. I am in the camp that I want a 30-year mortgage because it is a lot safer. My dad had went to a 15-year mortgage and paid his house off as quickly as possible. That was a long time ago. And my brother chose a 15-year mortgage to pay it off as quickly as possible, and that's what he's done. I, on the other hand, I still have a 30-year mortgage, and I am not paying mine off faster. I'm just letting it erode from the inflation. I have exactly what this is. I refinanced in 2021. Someone could take out a 10-year mortgage at 1.875. I took out a 30-year loan at 2.75. It says their payment each month, the difference here is 4,572 versus 2,041. And my payment's way lower than these, but that's the difference. And if you were to get into a problem or you struggle, the difference in the payment is massive in this type of scenario where you're paying almost double. So the way that I view this is life is a game, and it's about playing the game as long as you can. And if you can play the game as long as you can paper over certain slowdowns or spots that you struggle with. So the way that I view it is I am okay with paying longer on my loan, and I understand that the inflation rate is greater than my mortgage rate, and I knew that this was gonna. I thought that inflation was going to come and it was going to basically eat away my mortgage. So I locked in as long as I could. A 30-year loan, fixed rate, 2.75 is exactly what I have. And I'm not going to pay it off early, and it's a very low payment. I'm going to laugh at the payment that I have 20, 30 years from now. Like it's literally going to be nothing. And the inflation is going to erode this thing away massively. So that's my viewpoint. Also, I can play the game longer if something were to occur. If I have a large expenditure, I can play the game because I have a lower payment if I want to pay that low payment. If you lock yourself into a 10-year or a 15-year, your payment is really high and you subject yourself to greater financial stress if something were to occur, if someone were to lose a job or something like that. So, agreed. This did not age well at all. So this is Centelli, and he says, if somebody asked me where treasury rates are going to go on the 10-year, I'd say in the next 7 years, you should be able to see a 13.5%, 14% rate. This guy's saying, oh, that didn't age well. I think it's still going to go there. We're just going to have a pullback before it goes there. And it deals with he even has drawn there that pullback. You see that pullback that he had right there. There's the pullback that he's got drawn. It's going to pull back just like this. You'll go up, you pull back, and then it's going to go back up, probably to the September 1981 high. Totally agree with that. This pullback is the slowdown in the market. And that's what we're experiencing right now is that pullback, potential slowdown in the market that I think could potentially come. Totally agree with what he's saying here. But these people, they're so short-sighted that they can't even read what they can't even comprehend what he's saying. He even has drawn in here the pullback exactly how I would think. So I think Rick is right. For all those who are concerned that home values would crash in 2023, and to all those who forecasted they would, the Case-Shiller number currently stands at plus 6.3%. Just saying. Uranium yearly drilling highlights for 2023. F3 uranium, uranium energy, and ISO energy hitting some pretty strong numbers. And Forum Energy Metals is up there as well. I'm in a good investment in a lot of these up in the top because I think they have something. I think they do. Did the regional banks and Credit Suisse crisis in March and the United States Treasury yields reaching 5% in October scare you, or did you benefit from the opportunities these episodes created in terms of this movement here? So we're coming back down the 10-year yield. I think we'll bottom at some point, maybe in the 3.5% range, or maybe even where we're at. Notice how this looks. These movements here, this was the basing pattern. Well, no, this is on a shorter term. It looks very similar to a lot of the commodities that have broken out of a base, coming back to do a retest. And then maybe we'll see what occurs next. I thought this was crazy. Millennials have stated they need $525,000 a year to feel happy per Empower. That's a lot of money, guys. 525,000 that's almost top 1% in Colorado. That's top 1% in a lot of states. And what that's called is delusional. That's delusional. In order for you to feel happy, you need to make basically top 1% money. That's delusional. Texans actually pay more in taxes than Californians do, unless those Texans are in the top 1% of all earners. It probably has to do with property taxes and some of these other sales taxes if you're a bottom earner. That's my guess. But there's zero state tax in Texas. They do have high property taxes, though. How bad are things? Stocks at all-time highs, gold at all-time highs, home values at all-time highs, bonds up 5% for the year after historic 2-year bear market, net wealth at all-time highs, debt relative to incomes nowhere near historic highs. This things to be appear to be better than most think. To me, this just screams inflation. That's what I see when I read this, because you can't have all those things at all-time highs unless you have massive inflation. It's impossible. Because if stocks were at all-time highs, it would suck and draw currency from another sector. But they're all at all-time highs, which means we have massive inflation. 2023 home price growth by city. You can see some of the top cities, 8%, 7%. Thought that was interesting. And that's where I'm going to end it, as I'll end it there. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We do have a training session going on tomorrow, Thursday, 8 a.m. Don't forget about it if you're a part of the community. If you want to join, there is a holidays discount code in the bottom description link to join if you want to attend that training. That training will cover what my strategies and viewpoints are in the market, how to identify where value is in the market. I'm going to use the 3 pillars: ratios, technical analysis, and market conditions. I'm going to go over each one of those on how to look at it. I'm going to talk a little bit about portfolio positioning. We're going to look at some of the current data that I have across the board to give you guys an outlook on what I think is potentially coming over the next 5 years or so. And it will give you the courage of your conviction to hold on. That's really what it is. And you'll be able to identify really good entry points based off of using those tools. So you're going to see exactly how I approach something. And I'm looking for confluence of information. Confluence of information is the tons of information coming into alignment for a potential entry point. That's where you get the largest symmetry in the move. If you get something that's cheap, that's coming from a basing pattern, and then you get all this information like inflation and interest rates and all that stuff come into alignment. Okay, well, that's what I've got for today. We'll catch you guys later. This is Finding Value.